I mean, the Brent oil and oil prices in general have found some support in the last couple of days, and I think it was mainly driven by the OPEC Plus news.
Which company has succeeded through the energy transition the most so far? I think from a valuation perspective, it has to be Exxon and Chevron. These are the companies that have taken the most, cautious approach and, investing minimally in it. And that has quite clearly been the best strategy so far. But setting that aside, the most successful company within Europe's majors to begin diversifying their energy mix without undermining their earnings capacity would be Total Energies by far. They have the largest renewable power portfolio right now of the majors at 15 net gigawatts installed. And this is contributing meaningfully to results. It really is.
A dozen years ago, we remember, Elliott stirring the pot at Hess. Now, if you remember, Hess was a much larger integrated entity with far-flung assets. Hess came on in, I want to say around 2013. Don't quote me, but right around that time, they held about a 4.5% ownership interest. They got 3 seats on the board, and they pushed to streamline this massive organization. And if you recall from there, from that point, Hess separated its downstream and marketing assets. They sold off some upstream assets. They pushed out the midstream components. I think they IPO'd in midstream over 2 periods. But it really set up a streamlining of the integrated entity to becoming more of an upstream domiciled presence.
Example this morning, SolarEdge had its 4Q results out, and the stock is up around 30% here at the moment. We have a react on the company. They had a real reasonable start of a turnaround that we're seeing there in 4Q with improving cash flow, improved guidance for margins here in 2025. And so go check out what we think is unfolding there for that company. Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we've got the team that covers the integrated oil majors on the call. So quickly, we've got Salih Yilmaz joining from his usual perch in Dubai, swinging over to London. We've got Will Hares, and then hopping across the pond, we've got Vince Piazza. This team covers the largest oil companies on the planet. Salih covers Saudi Aramco. Will covers the European energy majors, as they like to be called there. So BP, Total Energies, Shell on down the line. And Vince covers Exxon and Chevron here in the US. So let's do a quick check-in on the commodity landscape before we dive into some of the really interesting things happening with those companies. So just looking at the screen right now, Brent crude's in the mid-70s here at the moment. So Salih, we'll come to you first just to get your read on the market. Give us your sense. A lot of headlines on OPEC crossing across the terminal here these days. What do you make of where we are in terms of Brent and where it could be headed in 1H and beyond?
Sure. Thanks, Rob. So, the Brent oil and oil prices in general have found some support in the last couple of days, and I think it was mainly driven by the OPEC Plus news. The news broken by Bloomberg News was that the group may be considering another delay of its planned output hike in April. This wouldn't be a very big surprise. It's not very certain yet, but the news was enough to give some support to prices. And I think that was the main driver. But beyond that, I think we have some other uncertainties around supply, and that's to do with Russia, Kazakhstan, and Iraq. When we look at Russia, we know and we've heard in the last couple of days that the G7 group is considering tightening the price cap on Russian oil exports, which can cause more disruption to those flows. And Kazakhstan is currently in talks with Ukraine after those drone attacks on a pumping station in Russia, which reportedly could reduce exports from Kazakhstan by up to 30%. So that's actually quite significant. And then we know that several thousand barrels a day of oil were offline in Iraq, and we're still awaiting return, although Turkey said these flows should return imminently. We are still awaiting the return of those barrels from Iraq via Kurdistan. So all of those combined, I think, have been supporting oil prices, and Brent now is just above $76 a barrel. But that's not to say that the concerns and the uncertainties on the demand side are going anywhere. We know the picture in China is still very bleak, and the demand in China is not so strong. And also there is another layer of uncertainty around tariffs and risk of wider trade wars, which could trim oil demand and could be an overhang on oil prices as well. And perhaps very briefly on the Russia-Ukraine peace talks. I mean, this is something that we've been thinking about in the last couple of days, because there are now talks and the potential end to the conflict. But our view is that even if there is, this probably wouldn't have too much of an impact on oil prices. I mean, this wouldn't really mean a big jump in supply. Flows from Russia have simply been redirected. We haven't really lost those barrels. And on top of that, Russia is constrained by the OPEC plus output cuts anyway. So they are their quota is about at 9 million barrels per day, so they wouldn't really be able to increase their output anyway. But beyond oil, we think that the impact on European natural gas prices would be more notable. Our team in Europe thinks that the price impact could be 5 to 10% if Russian flows of natural gas gradually resumes into Europe. But these also, I mean, the market seems to have moved a little bit on these news, but I think the talks are still in relatively early stages. But it is something that we've been thinking about. So I just wanted to mention that very briefly.
I want to swing over to Will and get your read as well, if you have one, on the geopolitical factors that could be feeding into the oil price sentiment. And it's probably always a good idea to do just a quick check-in on your names in terms of, obviously a higher price is generally good for oil companies, but, in the mid 70s, does that price sit well for the European oil majors in terms of their, shareholder, cash return strategy, these kinds of things that they're focused on?
Yeah, well, actually, I think 4Q results was actually a pretty good signal for where we're going to be for at least for the first half this year. And that was that the liquids weakness we saw in 4Q was largely offset by strengthening gas and LNG pricing. So we actually saw upstream and integrated gas units at the European majors relatively flat quarter over quarter. And as we know, European pricing has continued to climb, and oil international liquids pricing has been relatively flat. So I'd say overall the impact is largely offset for the time being. But that we are seeing a lot of volatility, obviously, in oil pricing right now. And so it is looking like a year that is going to be sequentially lower for adjusted earnings for the group by about 10 to 15% from last year, which already was a little bit pressured. So we are looking downwards for the group directionally.
Thanks. Vince, what's the story like in the US? Is it similar to how Will was just framing it?
Yeah, so for the most part, natural gas has really rallied hard with a colder winter. Balances look a lot better. So those with natural gas exposure have done well. And both of our names do have natural gas exposure. Exxon here in the US with its most recent purchases over the years. On the oil side, obviously we're sitting here. It's early yet, middle of February. Brent up less than 3%, crude up less than 2%. But Henry Hub nat gas is pushing 20% up on the year, and that includes a pretty strong close to 2024. Really, the upstream pieces of their businesses, this is exclusively the integrated names, the upstream businesses have really driven the performance for the integrated names. And that's obviously for Exxon because of the Pioneer acquisition, well-timed, as they were enjoying the fruits of that. But yeah, I mean, we can get more into it, but definitely Exxon is outperforming Chevron. And this is probably the second quarter or so that we saw them distancing themselves from Chevron.
Fantastic. Okay, so for anyone who doesn't see these on the terminal, make sure you check out reacts when we put them out. So if any one of us, if there's important earnings news or any kind of thing happening for your company, you can look at our first assessment of what market moving information could mean for a company. Example, this morning, SolarEdge had its 4Q results out, and I mean, the stock is up around 30% here at the moment. We have a react on the company. They had a real reasonable start of a turnaround that we're seeing there in 4Q with improving cash flow, improved guidance for margins here in 2025. And so go check out what we think is unfolding there for that company. I know we're sort of generally focused on oil here with the group for today's call. But in the vein of reacts, Will, you had a react recently on BP and what's going on with the company related to Elliott Management. And I think there's a lot of things unfolding for BP here at the moment. So it'd be great if you could unpack, how that company's performing and sort of what you think their 2025 could look like.
Yeah, thanks, Rob. So I think it's a good place to start is sort of why BP has found itself in the position it is. And that is it's significantly underperformed its peer group, its global energy major peer group for the last several years. It has a market cap of about 90 billion. If you compare this to Shell is at 200 billion and Total's at 140 billion. And notably, Total's upstream business is about the exact same size as BP's. So there's a very clear view here that the company's sum of parts valuation is much higher than where it should be. It's trailing its American counterparts but on a forward earnings multiple by about a third. So it's significantly undervalued versus its peers. And this is largely driven, I think, by two main factors. The first being its rapid and risky energy transition strategy that it rolled out in 2020. This is the fastest of peers. It envisioned a pretty dramatic drop in upstream production to 2030 and a pretty material rise in energy transition spending. This obviously has not panned out well. It's hit their returns. It's made their distributions unsustainable, which we think are going to be slashed in about half next week at its strategy day. And also, I think the other main reason why it's underperformed is a relative high exposure to Russia. So it held or continues to hold a 19.5% stake in Rosneft, which is one of the biggest Russian state oil producers, and it obviously has derecognized this from the business following Russia's invasion of Ukraine. And so it's suffered on two fronts there. It's loss of a big part of its upstream portfolio with Rosneft, and on the energy transition, way too fast, way too risky compared to some of its peers. And so this underperformance has now resulted in Elliott Management building a significant stake of about 5 billion in the company. And they're a famed activist investor. So we think that they're going to be very involved in pushing for transformative portfolio measures for the company. And sort of what we mean by this is taking a look at each of the smaller units. So we think, particularly in energy transition, we could see a spinoff or a full sale of the hydrogen business, of the EV charging unit, or a spin-off of the onshore wind, bringing a partner in for BP Lightsource, their solar unit, with the aim really of simplifying the portfolio to focus more on oil and gas. This is the company's, or should have been the company's, bread and butter for many years. We think that they'll eventually, or next week at their strategy day, probably announce a material revision to their upstream trajectory to 2030. Instead of declining, we think that's probably going to start rising. And we also think on maybe the more extreme measures that Elliott could push for a board change. The chairman of the board, Helge Lund, has been in place since 2017, and he's overseen what you could argue is a pretty disappointing tenure of performance. And also part of this, we could see a push for a U.S. primary listing on the New York Stock Exchange. This has sort of been bouncing around European energy major boardrooms for the last year or so. Some management teams expressing interest and taking the view that it represents one of the key hurdles to closing this yawning valuation gap between the European energy majors and their American counterparts, Exxon and Chevron.
Fascinating. I think it would be a sort of interesting development to see a company with the BP legacy name listed here in the U.S. I want to just ask a quick follow-up question. So you mentioned BP Lightsource. You know, the company has a pretty robust pipeline for solar as part of its plan. And I think you've been signaling for some time now that the European majors are really scaling back the energy transition plans. But like, what do you think about a company like this, 2030, 2035? You know, are they going to have solar? They're going to have wind, things like that in the mix? And what about their peers over there in Europe?
Yeah, so I think it's a good question, and it sort of drives right at the heart of this issue that has differentiated the strategies between the US and Europe. I do think that renewables will be playing a part longer term, 10, 15 years, absolutely. I think within the portfolios of these companies specifically, but I think the issue was the timing. And BP was very, very wrong on the timing of calling for peak global oil demand, which they did essentially in 2020. And the returns of these businesses are significantly lower than the hurdle rate for project IRRs in oil and gas, which is about 20 or 25%. So the expansion into solar has undermined their ability to pay dividends and buybacks, which as a very, very large oil and gas company, which is widely held by pension funds, particularly in Europe and the UK, really undermines their attractiveness as an investment case. So I think it boils down to a timing risk rather than an actual strategic long-term view. So I do think that Lightsource and offshore wind will play a role longer term. It's just they were too fast and too quick moving into it, and they've unfortunately been hitting their returns, and that trickles downstream to their distributions.
Fantastic. Vince, let's swing over to you. What do you make of the idea of a BP listing or a European oil major listing in the US? And I think you had a follow-up comment on the Elliott management stake as well.
More specifically to the Elliott management. For those of us in this business a dozen years ago, we remember, Elliott stirring the pot at Hess. Now, if you remember, Hess was a much larger integrated entity with far-flung assets. Hess came on in, I want to say around 2013, don't quote me, but right around that time, they held about a 4.5 ownership interest. They got 3 seats on the board, and they pushed to streamline this massive organization. And if you recall from there, from that point, Hess separated its downstream and marketing assets. They sold off some upstream assets. They pushed out the midstream components. I think they IPO'd the midstream over 2 periods. But it really set up a streamlining of the integrated entity to becoming more of an upstream domiciled presence here in the U.S. with significant cash flowing assets outside of the U.S. And what did it also do? It also gave them the ability to invest in Guyana, which became a very key asset and a transformational asset for them, which really gets me to the point of, do we really need an integrated entity here in the U.S.? And I think that's somewhat controversial, something that we've talked about and written about a lot in the work that we've done on Exxon and Chevron. And we can get more into that, but just in general, here in the US, we have a very liquid and deep equity market. Each individual investor has the opportunity to create the exposure that they would like to create. I can recreate an Exxon, I can recreate a Chevron with upstream names, with downstream names, with chemical names, and also with infrastructure names. I don't need a large entity to do that diversification for me. I can do it cost effectively as well. And so we saw years ago, Conoco and Marathon push out their downstream pieces and focus on the upstream business. And oh, by the way, Marathon and Conoco are getting together. Their upstream pieces are getting together. So we are seeing a streamlining of what's important. And right now, the upstream components for Exxon are driving its performance. And I realize that there are some synergies to having this integrated portfolio, but for the investor who can recreate the assets, it may not be as suitable for the underlying investor. Now, that may be different in Europe and in other parts of the globe where markets may not be as deep and liquid, and I'd love to get some of Will's comments on that.
Yeah, thanks. I think it's a really interesting point that you just brought up, because it tracks with what's happened in Europe as well. And that is that I think the European majors have been pulled in 2 separate directions. They've been pulled in their traditional oil and gas investor direction, and at the same time, there's a heavy ESG sustainability presence within European investment management as well, or at least there has been, and that's for the last decade or so. And so the strategy for these companies has kind of been stuck between a rock and a hard place. They've been trying to placate their traditional oil and gas investors with returns, with buybacks, with dividend growth post-pandemic, and also at the same time invest in energy transition, bring down their carbon intensity of their portfolios, and gradually start easing off in their upstream portfolios, not really reinvesting in exploration or reserve replacement. And really what's happened is, for most of these companies, is that they've ended up placating neither the oil and gas investors and neither the ESG investors, because the oil and gas investors are just going to go over to Exxon or Chevron because they want upstream exposure. And the energy transition, ESG more oriented investors can go to a First Solar or a SolarEdge or offshore wind, So like, just as Vince is saying, you can create the portfolio exposure you want, but for these companies, it's been a very difficult dynamic to navigate strategically, because they've been trying to keep everyone on both sides of the fence happy.
Thanks, Will. Let's do a quick vibe check and switch over to the Middle East region. Salih, you cover Aramco. believe when they IPO'd, they might have been the largest market cap in the world. Amazon, Nvidia, Alphabet, handful of other names I think are tad larger at this point. But I don't get the sense that any of this energy transition stuff is really playing into your company's names there, or any of the kind of struggles that Will was describing are part of the narrative there. But you tell me, how's Aramco looking? What are you expecting for 4Q when they report out?
Sure. I mean, Aramco has always been quite confident about continued growth in oil demand. I mean, they've made some early, remarks about starting to invest in things beyond just oil and gas, but their approach has very much been focusing still on molecules, still on petrochemicals before all the other paths that we see, perhaps that we've seen perhaps with some of the European majors. But the special position and the unique position that Aramco is finding itself in is right now that it's struggling with the similar macroeconomic headwinds, just like its global peers. But because it is responsible for the totality of Saudi Arabia's production, that's usually around 10 million barrels per day, that means they have to follow the directives from Saudi Arabia, which is the de facto leader of OPEC Plus, which has been doing these output cuts for a while now. And as we discussed earlier on the call, it looks like they may delay their planned output hike in April. So what that means for Aramco is that their production level is essentially stuck at just below 9 million barrels per day, which is way below their maximum production capacity. So that has been an overhang for the company. And of course, beyond that, oil and gas prices being relatively weak still. I mean, operationally, Aramco can break even at much lower prices, but the Saudi Arabia needs a much higher oil price to fiscally break even. So Aramco has kind of been stuck in between, and it's had to introduce these special dividends, these performance-linked dividends, majority of which goes to the kingdom and funds the kingdom's transformation projects. So right now, where Aramco is finding itself in is its profitability is easing from the levels that we saw in 2022. It has promised these performance-linked dividends, but this has meant that in the last few quarters, it has been paying dividends at just about $30 billion every quarter, which is way higher than the cash generation that they had every quarter. So every quarter, their net cash position has been trimmed down, and last quarter, as we anticipated, their net cash position flipped into a net debt position. And we expect in the fourth quarter that net debt has grown a little bit more. And when they report early March, we will be looking for a little bit more guidance on what they will be doing with their dividends through 2025. Even if they keep it, because of the formula for these special dividends, that is linked to the profitability from the previous year, and 2024 being a less profitable year than the previous years, they should be paying lower dividends anyway. So that is going to help their financial position a little bit. But yeah, guidance on dividends is what we'll be watching in the fourth quarter, results in early March. But beyond that, general messaging for Aramco is that they are very much committed into oil. They are growing their non-associated gas production, and where they're growing in terms of energy transition is not necessarily into renewable power generation, but it's more geared towards petrochemicals.
Thanks, Salih. Let me do a quick bit of advertising before we continue the conversation. We're going to run over as we usually do. So we hold these calls every Wednesday. Next week, we're going to be joined by a guest speaker. So Paul Chang, who's at Scotiabank, is going to be joining. He's kind of got a very similar overlap of coverage with Vince, senior analyst, managing director, covering U.S. integrated, some of the upstream names. Also next week on so Wednesday at 3 p.m., we're going to be holding a small roundtable in our Miami office. So Mike McGlone and I will be there. So if you're available and you're based in the region, reach out. We'd love to say hello in person. And the last bit of advertising, on March 6th, so the following Wednesday, Vince Piazza, Scott Levine, Talon Custer, and I, we're all going to be in New York that day. So we're going to hold an event probably at 3 p.m. We're still trying to get a space reserved for where we're going to hold it, but in-person roundtable in New York that day. So we very much appreciate everyone who joins these calls, but just want to flag that we've also got opportunities to say hello to us in person and meet some of your peers. So if you're interested in any of those events, reach out. We're happy to help you get pointed in the right direction. So there are some questions in the chat that I want to get to. So if you got some, we'll try to work through those as well. So one of the ones, Will, that I think is appropriate for you is related to the idea of a BP Shell merger. And, I know you can't comment on rumors really, but give us a sense, what do you make of that idea, and sort of M&A activity generally in your space?
Yeah, it's a good question, and one that's been, pinging around, particularly in the last couple of weeks, particularly as it relates to Shell. And I think that I can understand why, because that's really the only suitor that this would sort of be possible for to acquire. But in short, I think it's highly unlikely. And the reason for that being is Shell has been extremely capital disciplined over the last several years, particularly as it relates to the energy transition. They have which I think is a key differentiator in why BP is struggling the way it is and why Shell has not. So I think that if Shell did make a move, it would represent a stark departure from the strategic framework that they have been following, and in particular, the CEO Wael Sawan has implemented since he came in. He has not been a big fan of making M&A deals. They have a very high bar to reach to justify the metrics for making M&A deals. And then also there's enormous risks involved here for a mega merger of a size like this. There's cultural risk. There's a lot of cost cutting that would have to occur. There's operational risk there as well. There's antitrust risk, and I just think based on my knowledge of the company and Shell's management, they are doing relatively well right now. I would be very surprised if they wanted to, start rocking the boat with an enormous mega merger involving multiple new energy transition units and businesses and putting them all together. I can see why people are talking about it because of the valuation discrepancy, but I think in reality it's just unlikely.
Vince, I want to swing back over to you. I think you had a comment that you wanted to add in along this discussion.
Yeah, so when we talk about the idea of mix of legacy hydrocarbons and a mix towards renewables, the one thing that comes to mind for me is we have companies that do this. We have companies that are involved in this. So a legacy oil and gas company is a legacy oil and gas company, and that's what they should be investing in. And I think that's what, in general, we tend to view here in the U.S., again, as a relatively deep and liquid equity market, that we can make those decisions on our own. And we do not need any outside forces moving that discussion or moving that debate.
Thanks, Vince. Well, along those lines, we do have a question from one of our listeners today, and I think this will be a good round robin question to end on, and maybe you can think about it for each of your coverage. So in your opinion, are there any oil majors that are successfully navigating diversifying their energy mix that you were just talking about there, Vince, towards renewables or energy transition. So, Will, when you think about your coverage portfolio, I do feel like the European names have tended to be ahead of the general pack on this, certainly compared to where the US guys are at, or where some of the names that Salih covers there in the Middle East. But what's your sense? Which company is out ahead on this?
Well, so it's an interesting way to frame the question. It's which company has succeeded through the energy transition the most so far? I think from a valuation perspective, it has to be Exxon and Chevron. These are the companies that have taken the most, cautious approach and, investing minimally in it. And that has quite clearly been the best strategy so far. But setting that aside, the most successful company within Europe's majors to begin diversifying their energy mix without undermining their earnings capacity would be TotalEnergies by far. They have the largest renewable power portfolio right now of the majors at 15 net gigawatts installed. And this is contributing meaningfully to results. It really is. So their integrated power unit, which also includes some of their gas turbines, it is now contributing 20% to their bottom line in each quarter, and 60% of the power sales is weighted to renewables, and just to frame it, the balance sheet is still very, very strong at TotalEnergies. They maintained their buyback, they've upped their dividend, and they're also increasing upstream production for the next few years. So it's not coming at the expense of upstream either, which is what we like to see, and it's what we haven't seen at BP.
Fantastic. Well, I love your framing of that. I love the idea that, that the success benchmark is doing it without affecting earnings capacity. Salih, we'll come to you. Is this something that you even think about for your region? I mean, I think sort of, at the big thematic level, maybe there's some interest there, but tell me, is there a company that comes to mind for your coverage?
Yeah, I mean, generally, I agree with Will, and with some of the companies that we cover, especially in Europe, and some of the bets that they're making, I think it's rather early to say which one of those bets may pay off, maybe in the future beyond the very near term. But I would say that the approach taken by Saudi Aramco and companies like OMV, which are betting on petrochemicals, which is kind of their way of doing energy transition, makes a lot of sense for them because they are very strong in downstream. They want to grow in downstream, and this actually makes a lot of sense for them to lock in demand for their own crude oil in the future as well. And again, I mean, when you look at the petrochemical space, it's been very weak in the last couple of years, and its recovery is proving to be very, very slow. So it may not look like a great bet, but I think in the very long term, it just made a lot of sense for them because they can integrate that very well into their existing legacy oil and gas business.
Fantastic. Okay, so that's an interesting framing. So in Europe, it sounds like we've got this idea around, power, gas, renewables, helping TotalEnergies. Salih talked about this petchem idea. So we're gonna frame energy transition pretty broadly. But Vince, when you think about your space, I feel like the strategy's been pretty different here in North America. But what name comes to mind as you think about this topic for your coverage?
Well, when I think about the incremental investment, Exxon did purchase Denbury to help with carbon capture. That was a very modest acquisition when you compare it to the 60 some odd $billion transaction to double down on the upstream oil and gas business by buying Pioneer in the Permian. So while they have looked at ways to invest in carbon capture to help its initiatives, its nascent initiatives in that space, for the most part, it's been doubling down on the things that they know best, and that is upstream oil and gas extraction.
All right, fantastic. We'll have to leave it there for the last word. But again, thanks to everyone who joined. We do hold these calls every Wednesday. Next week, we should have a fun conversation with Paul Chang from Scotiabank. We've got the upcoming roundtables in Miami and New York. Hope to see you there. And as always, we're green dots on the terminal right now. Shoot us an IB or an email and ask any follow-up questions that might be on your mind. Thank you for your time, and we look forward to being in touch. Take care, everyone.